Good morning and welcome to the Signia Monthly Market Review. My name is Gregoire Sharma and I'm the Fixed Income Fund Analyst here at Signia. June saw a continuation of the global economic rebound where risk assets outperformed safe havens. The gradual easing of lockdowns across developed economies has led to inflation prints beating expectations yet again. Investors, however, seem to play down inflation concerns, falling in line with the US Federal Reserve's rhetoric of higher inflation levels being of a transitory nature due to COVID-19 base effects. Volatility did spike intra-month following the Federal Reserve's mention of asset purchase tapering, but quickly eased off, leading to positive equity returns and lower bond yields in June, despite increasing COVID-19 caseloads and worries surrounding the more contagious Delta variant. There's a sense now that vaccinations are mitigating serious illness and hospitalizations, which bodes well for reopening of economies in developed countries, but for now continues to exacerbate the growth differential between developed and developing economies. Looking at asset class returns, fixed income markets saw most indices finish in positive territory, despite the US Federal Reserve talking about tapering asset purchases and scaling back its COVID-related programs. Expectations for the first rate hike were brought forward to 2023, which saw volatility increase and yields spike initially. The hawkish tone was later played down by Chairman Powell, leading US 10-year yields to finish the month lower at 1.47% and the global Treasuries index to rise 0.4%. In spread sectors, global credit indices generated positive returns, with investment-grade credit returning 1.15% in June, outperforming high-yield credit thanks to the asset class's inherent higher sensitivity to moves in interest rates. High-yield credit finished the month up 0.82% on the back of higher commodity prices and investment-grade rating downgrades, which meant inclusion of higher quality issuers in high-yield indices, further leading to spread compression. Emerging market debt indices were mixed in June as both hard currency sovereign and corporate indices finished the month in positive territory, posting returns of 0.76% and 0.4% respectively. EM local sovereign debt underperformed significantly due to the negative performance of EMFX, ending the month down minus 1.16%. In equity markets, US equities achieved the highest return in June to outperform its developed market counterparts, with the headline index up 2.3%. The Nasdaq index, which is technology heavy, performed particularly well, up 5.5%, as lower bond yields and renewed concerns surrounding the economic impact of the Delta variant ushered investors into higher growth assets, shunning value assets. Cyclical companies therefore underperformed, leading to UK, European and Japanese bourses to post relatively modest returns for the month, whilst Chinese markets delivered negative performance owing to more virus cases and continued monetary policy concerns. At a global sector level, higher growth parts of the market were clear outperformers in June, with those stocks classified in the consumer discretionary and, particularly, information technology sectors benefiting most from lower bond yields and economic growth concerns. The majority of sectors most sensitive to the global economic cycle, such as financials, industrials and materials, were all down over the month. However, the one exception was the energy sector, which continued to perform well in light of the oil price rally. Finally, turning to commodities, it was a mixed month for the asset class as energy outperformed on the back of ongoing recovery in demand as economies are slowly reopening. Furthermore, supply discipline from OPEC Plus countries sent the WTI oil price soaring 10.78%. Gold, on the other hand, generated negative returns of minus 7% on the back of a rising US dollar, further suffering as risk-on sentiment saw investors shun the asset class in favor of riskier assets. That's it for the month. See you for the July market review.